Thank you all for joining this Blockchain Coinvestors webinar. My name is Topher Nelson. I'm the head of digital asset research at Blockchain Coinvestors, and it is my pleasure to welcome you all to the Q1 edition of our biannual institutional digital finance adoption report, which tracks blockchain and digital finance adoption among the world's 50 largest financial institutions. We are a fund manager, so I do have to show you this disclaimer. Today's webinar is meant to be purely educational. Nothing mentioned here today should be construed as investment advice, and you should always conduct your own research. If you are interested in learning more about our funds, you should reach out to us directly, and I'll share the contact info at the end of this presentation and rely only on the primary fund materials, which we'll be happy to share. And this is who we are at a glance. It's been about 10 years since we pivoted to be focused on blockchain. We're a specialist asset manager focused entirely on blockchain investing. We manage 7 funds, which gives us the exposure shown on the bottom row here. And as of today, we're super proud to say that we have capital deployed across more than 1,250 blockchain companies and projects in Europe, North America, and Asia, including over 110 unicorns valued at over $1 billion, which is really remarkable by any measure. And you'll see their logos on the following pages. About 50% of the capital we invest is invested in Europe and Asia, giving us global coverage, which reflects the global nature of Web3 itself. And all in all, we're very proud of these metrics, which we believe really speak for themselves. This is the investment thesis our founding partners wrote down almost 10 years ago now. And while the pace of blockchain adoption has surprised even us, the core themes of our thesis remain largely unchanged. These facts were true 10 years ago, they're true today, and they'll still be true 10 years from now. Really, because we're in the middle of a very substantial transformation. Just as communications and content went digital over the past 20 years, the future of finance is also digital. And the digitalization of commerce and finance, which is being enabled now by blockchain technology, will be the greatest value creation event some of us will ever see in our lifetimes. And for about the past 10 years, actually, we've been putting out a detailed webinar on investment thesis, so I won't spend too long here today. But if you're curious on why we have such high conviction in our thesis and essentially how we know what we know, I really recommend heading over to the website to check that out afterwards. And our goal, which you can see here, is to provide our investors with a fairly simple value proposition. Make a single investment and get global, diversified exposure to the world's best early-stage blockchain companies and projects, all on an institutional platform. And this is something we think no one else can offer you today in the way that we can, especially with the global coverage, which is absolutely critical in the sector. To deliver on that ambitious value proposition, we partner with more than 40 of the top VCs and investors in the space, whose logos you can see here, some of which you may already know. And these represent some of the best minds we believe in blockchain and Web3 and fintech, and we're very proud to work with each one of them. And as I mentioned before, these are the logos of the 110 plus unicorns we're invested in. Some of these will be household names to you again, and this list includes both traditional equities and venture investments in traditional companies like Chainalysis and Ledger, for example, which sell compliance software and hardware wallets. But this also includes early stage tokens like Bitcoin and Ethereum and tokenized projects like Filecoin, really spanning the entire blockchain and digital finance ecosystem. So it's a very diverse group, but all of them valued at over more than $1 billion, and we're very excited to be investors in each of them. Stuck here. So as part of our efforts to keep our LP community up to date with the latest developments, we put out 3 biannual research reports, which you can see here. They're now featured in a handful of publications, and they help formulate our own evolving investment strategy. So today's webinar marks the 3rd edition of our biannual institutional digital finance adoption report, which tracks blockchain adoption among the world's largest financial institutions. In December and July, we published our Meet the Blockchain Unicorns report, which tracks early stage value creation in Web3 and also represents the world's most comprehensive database of blockchain unicorns. And in April and October, we published our biannual regulation reports, which track the state of blockchain and crypto regulatory progress around the world. And all of these reports are available on our website at blockchain.investors.com/either adoption, regulation, or unicorns. And we'll dive into the adoption report results in a moment. But before we do, I just wanted to touch on the results of our last unicorns and regulation reports. 6 years ago, when we started publishing this unicorns report that you can see here, there were less than 10 blockchain companies in the world worth over $1 billion. But I'm proud to say that as of year-end 2024, there were 111 enterprise unicorns and 126 crypto tokenized projects trading above $1 billion, which is just crazy. And taken all together, which is what you can see on the chart here, the enterprise unicorns and the tokens cumulatively make up nearly 17% of the world's 1,400 plus early stage companies worth over $1 billion. And that means that almost 1 in 5 early stage unicorns today is blockchain related, which is really remarkable in such a short time, maybe about 15 years since blockchain has really come about into the world. So the value creation in our sector is really exploding. And looking at the regulatory landscape from our regulatory report, story is similarly positive. Just a few years ago, this map would have been 90% red. Few jurisdictions around the world had regulations or guidance in place even for basic blockchain activities or basic tax accounting. Today, however, most of the world's leading financial centers are passing or preparing pro-innovation regulation for digital monies, commodities, and assets, and new hubs are beginning to emerge, all hoping to be the Silicon Valley of tomorrow by enabling digital finance. So things are really progressing quite quickly on many fronts, but we're here today to discuss institutional adoption, so let's dive into the report. So in order to gauge the state of digital finance adoption around the world among institutions, we maintain a database of the top 50 banks and asset managers by assets under management, and we regularly measure their progress with regards to digital finance adoption across a handful of key service offerings. So on the left-hand side of the tracker on the following pages, you'll see the world's top 50 financial institutions, their headquarter locations, and the current estimated assets under management, either as of year-end 2024 or into 2025. And on the right-hand side of the tracker, to assess their varying levels of adoption, we analyze whether they offer or support the use of different forms of each of the following digital finance service offerings, including digital wallets, custody or trading, digital monies, digital commodities like the Bitcoin ETFs, broader digital asset investments, or also if they participate in digital asset issuance or distribution, what you might call tokenization, and lastly, if they offer private blockchain or crypto funds to their own clients or high net worth individuals. But before we dive into the actual results, just to add some color to the population in question, the world's top 50 banks and asset managers by assets under management together represent cumulative assets under management of more than $130 trillion and hail from 9 countries. So just a massive swath of institutional capital. The US makes up the largest single country by assets under management representation, but Europe and Asia are also well represented, and they're home to quite substantial capital also. So it's really a broad swath of capital and geographies represented here, which at its core represents the world's biggest 50 financial players, really the who's who of institutional global money. So now let's dive into the tracker. So this is the first page of the tracker, and as you can see here, the world's biggest financial players are, in fact, quite active in blockchain already. The largest managers in Europe, Asia, and North America, which you can see here, already have live products and service offerings in many of the key areas of digital finance. And among the top 25 managers globally shown here, Vanguard is really the only remaining holdout, which is a position that's getting harder and harder to defend. Edward Jones and Barclays are also a bit behind in this regard, but they don't share Vanguard's, you could call it, openly critical view of the industry. They're simply moving slowly, being cautious, and sticking to their bread and butter and traditional assets. In terms of the leaders here, BlackRock, which we'll discuss later on, is clearly emerging as a leader in digital asset capabilities, and they've struck a handful of landmark partnerships with some of blockchain's biggest names. Fidelity was also quite early to the space, and we'll again discuss a bit more later, but they've notched a handful of notable firsts already among TradFi institutions like first to allow Bitcoin purchases in 401ks, and first to introduce 24/7 multi-asset crypto trading in their native app. And not to be forgotten, State Street and JP Morgan are also quite advanced, despite lackluster regulatory progress in the US in the past few years. As we move down here to the second page of the tracker, institutions 26 through 50, things thin out a little bit, but it's also not that surprising. The larger firms on the first page generally have deeper financial resources to allocate to R&D and new emerging tech, and often dedicated legal teams to navigate new regulatory landscapes. But nonetheless, we still see a handful of household names here leading in digital finance, like Wells Fargo, UBS, Societe, Franklin Templeton. So as the larger firms plot their way forward here and navigate the regulatory swamp, particularly in the US, and as regulations are ironed out through the year, we expect to see a lot more of these smaller firms getting involved. And by our next report, we expect to see essentially a lot more green on the second page. Overall, institutional adoption is tracking right along with value creation and regulatory progress, and it's been very impressive. The world's 50 biggest financial institutions are actively integrating digital finance. More specifically, of the world's top 50 financial players, more than half now offer or support the use of digital wallets, custody, or trading. About half now offer and support the use of digital monies like CBDCs or stablecoins for payments. And following a bunch of ETF approvals last year, which notched record inflows around the world, 32% now offer or provide digital asset commodities like the Bitcoin ETFs. This past year has also been a really landmark year for tokenization. It was characterized by headlines like the BlackRock securitized partnership. And as a result, 42% of the top 50 managers globally are now involved in some way in digital asset issuance or distribution, or what you'd call tokenization. And I'll note that figure is up 4% since our last report, biannual report, but versus the report before that about a year ago, it's up now 20%. So it's really signaling a growing focus on tokenization among institutions. But at the highest level, things are progressing quite quickly across the whole range of digital finance capabilities. Looking regionally, however, we see some different themes emerge, and I will spend some extra time here today, just given we have, it looks like a lot of investors from the line from the US. So from an institutional adoption perspective, it's been a really blockbuster year in the US and North America. Early last year, the SEC in the US greenlit a whole family of Bitcoin spot ETFs, which went on to become the most successful ETF launches in history. The House advanced its first sensible, bit quite early pieces of legislation, and a handful of antiquated policies were repealed or at least questioned, although a lot of that progress was vetoed by the Biden administration. But since then, the momentum has only grown. Early on in his campaign, President Trump differentiated himself by rising up to support emerging technologies like crypto and blockchain, which the Democrats hadn't been doing. And in November, on the campaign trail, he pledged to create a strategic Bitcoin reserve if elected. Then following his election, Bitcoin soared. And in December, Trump appointed crypto czar David Sachs, which is really a huge win for the industry. Sachs is a former COO of PayPal and a longtime blockchain and crypto supporter. And Sachs was also followed by a string of other pro-crypto candidates, many of which we know and sit on various boards with, like the new SEC chairman, Paul Atkins, which Matthew sits on the Securitized Advisory Board with. And all in all, this really brought renewed momentum to the space. And that's what took Bitcoin past 100K for the first time and up to 109K at its max. Not to be forgotten here, also that Elon Musk was a cornerstone of this all-star crypto cast. And he's now intimately involved in the US government if you've been watching the news. But he's been a longtime supporter of crypto, including specifically the meme coin Doge, or Dogecoin, which Tesla began accepting for payments in really an unexpected move last year. And in January, Grayscale, one of the largest crypto fund managers, launched a fund for Dogecoin, which marks the first large-scale institutional meme coin fund, which I think if you'd have told us 2 years ago, nobody would have believed that would exist by now, but it does. And now, since his inauguration in January, Trump has already issued two critical orders to note here. First was an executive order establishing Doge, not the crypto, but the Department of Governmental Efficiency, to be headed by Elon Musk, with the mandate of improving governmental efficiency and modernizing federal technology, and specifically federal financial technology. And while the order didn't specifically mention crypto, the department's mandate clearly is about modernizing federal financial technology. The department shares a name with the world's biggest meme coin and is headed by Elon Musk, whose company is the largest public supporter of that meme coin. So no comment on there. But right after that, Donald Trump issued a most certainly crypto-related executive order called the Strengthening American Leadership in Digital Finance Order. And that accomplished four key things. And this is just in the past month and a half. First, it revokes antiquated Biden-era policies, which were in some ways stifling the industry and more hostile than open regulation. Second, it prohibits a U.S. central bank digital currency like a Fed coin, and that's something that's been discussed in Washington now for a few months. Third, it establishes a working group on digital asset markets, which is tasked to report to the president and propose a federal regulatory framework for regulating crypto in 180 days. And finally, it outlines clear policy objectives just that promote digital asset leadership and specifically expand on the use of dollar-backed stablecoins. So really, altogether in the past year, and particularly in the past 2-3 months, we've seen a string of regulatory and political wins in this space in the US, which altogether have made it much more investable from an institutional perspective. So when we look at these survey results on the bottom half chart here, we're not surprised to see so many US financial institutions are rushing to embrace digital asset technology and already have been in order to set themselves up for this inevitable change in legislation. And, as compared to just a year ago, the administration is now very pro-crypto. We have a pro-crypto president, the most pro-crypto Congress in history, new crypto czar. The new SEC chairman is on the advisory board of the world's leading tokenization firm, Securitize, along with our partner, Matthew. There's a new government department, kind of named after a meme coin and headed by longtime crypto and meme coin supporter Elon Musk, tasked with modernizing the government's financial infrastructure. There's talks of a strategic Bitcoin reserve, and some are even suggesting, although it's probably a bit far-fetched today, moving the whole federal financial system onto blockchains for auditability and transparency. And I think it's a bit far-fetched today, but it's certainly something blockchains could do. And I don't think it's unrealistic to expect that in the future. Looking across the pond, as it were, at Europe and the UK, institutional adoption is also fairly advanced and moving quickly. The EU was well ahead of the US in proposing their really comprehensive crypto regulatory framework early on, known as MiCA, or Markets in Crypto Asset Regulation, MiCAR. And as of December, it's now fully live and implemented across the EU. There are a few laggards which joined late, like France, but they're just a few months behind, and they'll be fully live by mid-year. And really, all of that regulatory clarity in Europe has allowed European financial institutions to begin onboarding crypto capabilities across the board. And that's what we see on the bottom half here. We're also starting to see European asset managers disclose significant Bitcoin ETF holdings, like Capula Management in London, which manages more than $30 billion, who disclosed that of their $30 billion holdings, they held nearly $500 million in Bitcoin ETFs as of August. We're also seeing crypto exchanges flock to secure licenses under the new MiCAR regime. And as a result, Europe has seen a flurry of activity from market makers, exchanges of different types trying to establish a foothold in the new regime. Galaxy Digital had already partnered with DWS to launch crypto ETFs in Europe last year. And in February, BlackRock announced it was also preparing to launch its first European Bitcoin electronically traded products, or ETPs. Standard Chartered just set up a new entity in Luxembourg to provide digital asset custody services in the EU, really also as a foothold to get started there. And just last week, European Central Bank board member Piero Cipollone said in an interview that he hoped Donald Trump's support for US dollar-pegged cryptocurrencies would speed up the legislative backing for the digital euro project. And he stressed urgency, remarking specifically that U.S. leadership in this regard could lead to, I quote, yet another U.S.-made global payments tool, essentially a call for urgency to not be left behind in this race. And in the best case scenario, the EU's Parliament and Council could wrap up work on the digital euro legislation before the summer, paving the way for negotiations with the Commission. And that would leave room for new rules to be finalized by November, which is when the European Central Bank policymakers are set to vote on whether or not to launch the digital euro officially. And if that moves forward, that would certainly jumpstart a wave of institutional adoption. And it would also likely be a stepping stone to institutional DeFi participation as well. In Asia, institutional adoption is trending as well, but it's, of course, more geographically stratified. So China was early to central bank digital currencies and has integrated the eCNY digital yuan into a handful of major cities and transportation systems, although it is technically still in an extended pilot, but it's processed more than 1 billion transactions, so it's quite an advanced pilot. And as you can see on the bottom half here, all the Chinese institutions have, of course, built out digital wallets, custody, and payment tools for it, and that happened very quickly. China is still wary of decentralized products like Bitcoin and Ethereum, but they've natively integrated digital payments, aside from Bitcoin and Ethereum, using the digital yuan, really to a degree that most people don't appreciate in the West. I mean, you have to visit or at least go on YouTube and check it out to understand how exceedingly digital their economy is. And their newly issued national data infrastructure guidelines also highlight blockchain technology specifically. So we expect to see these trends continue in China. Japan is similarly advanced, and their financial infrastructure is also quite digital. I mean, it's really shockingly impressive. Institutions like Mitsubishi and Sumitomo are also quickly emerging as leaders in digital assets capabilities. And not to be left behind, Japanese multinationals are also in on the action. Nomura is actively exploring yen and dollar-backed stablecoins. And Sony just unveiled their proprietary Layer 2 blockchain platform, Sonium, which is designed to bridge Web 2 and Web 3, both for finance and entertainment. Looking at Hong Kong and Singapore, who are a little less represented, of course, in the top 50 financial institutions surveyed in our report, things are also advancing very rapidly, and Hong Kong and Singapore are both quickly becoming digital asset hubs. And this is no accident. They position themselves this way over the past 5-6 years. Hong Kong, for example, is actively encouraging investment and has created tax exemptions, for example, for crypto taxes for hedge funds and family offices. Singapore, in the past year, doubled its digital license issuances, and we've seen a handful of crypto-native institutions set up headquarters there, like Crypto.com. And when we look at the talent pool, we can see why institutional adoption is likely to continue to surge in Asia. According to Electric Capital, who puts out one of the most comprehensive reports on the talent pool and developer population behind Web3, between 2015 and 2024, Asia's share of global cryptocurrency developers and Web3 developers shot up from 13% to 32%. And during the same period, North America's share dropped from 44% down to 25%. So this is already becoming a geopolitical race for the future. But all in all, the world's largest institutions are actively embracing digital finance already. And when we look at the uptake of blockchain-based tools like stablecoins, this makes total sense. In just a handful of years, really, stablecoins have found absolute product market fit, and they're a case study to behold in blockchain. Global payment volumes settled in stablecoins overtook PayPal volumes already a few years ago, and are now overtaking the leading credit card networks like Visa and MasterCard combined, which is just super awesome to see from someone who's been in the industry a few years. We've seen people criticize and naysay about stablecoins, and they're now reaching an impressive, shocking scale. And at this point, it's pretty safe to say, I think, that stablecoins will soon overtake worldwide ACH payments as well, which they should. ACH payments, or automated clearinghouse payments, are batched and sent to automated clearinghouse operators, who then process and settle the funds between banks, taking on average 1 to 3 days on the back end, even though most consumers don't actually see this process. And that excludes holidays and not banking hours. And users end up typically paying exorbitant fees to cover the extensive organization overhead required to oversee all those manual checking processes of the automated clearinghouses and such. Stablecoins, by contrast, move nearly instantaneously with fees that are fractions of a penny, even on large amounts. And all the back-end work of confirming and verifying transactions that the automated clearinghouse process is done instead by public network participants who earn rewards for securing the network and processing transactions. So as the world's financial systems continue to shift over to natively digital rails, it's also likely stablecoins will eventually overtake Fedwire by volume as well. And this will only be spurred on further by the emergence of central bank digital currencies, which we're already starting to see around the world. Interestingly, stablecoins are also now a top 20 US debt holder, just underscoring how interconnected crypto is becoming with TradFi. And this is also quickly adding credibility to the technology. And as a result, governments around the world are passing or advancing stablecoin legislation quickly, now including the US. And as I mentioned before, we now have the most pro-crypto administration, president, government, Congress, all the above that we've ever had in history in the US. And more notably, maybe, is that this is a completely bipartisan issue now. Being anti-innovation is not an easy position to defend, and a lot of people have abandoned their anti-crypto positions in the past 4 to 8 months. And the numbers also clearly have shown that developers and innovation have been heading offshore as a result of hostility in the US. So now there's clear support for digital assets on both sides of the aisle, really. And we expect the Trump administration will help bring Web3 innovation and value creation back to the US. So all in all, where are we today? We're through more than a decade of technological development now. Blockchains have gotten magnitudes faster, more secure, and more scalable at really unprecedented rates when you look in comparison at the development of the internet, in which it took 40 to 60 years really to reach this scale of commercialization. Bitcoin also continues to be the world's best performing asset, outperforming all other asset classes. And now the world's most powerful financial institutions, the who's who of big institutional capital around the world, are investing and adopting technology. And so I'll just double click on a few now of those institutions to add some color. You may have heard of BlackRock. BlackRock is the world's largest financial institution. They manage nearly $12 trillion, which is more than the GDP of most countries. In fact, as an economy, BlackRock would rank third as the world's third largest economy, behind only the US and China. So really a massive financial player. And BlackRock is already today, arguably, the world's leading adopter of blockchain technology among institutions, which is just shocking. And I don't think enough people quite appreciate this yet, but they will very soon. By 2021, BlackRock had already invested nearly $500 million in crypto miners. By 2023, they'd already struck partnerships with Coinbase and Circle, two of crypto's absolutely biggest names. Last year, they launched a Bitcoin ETF, which went on to notch record inflows and later an Ethereum ETF. They also struck one of the year's hottest deals last year with tokenization leader and portfolio company of ours, Securitize. So despite their CEO in 2017 calling Bitcoin an index of money laundering, BlackRock is today the world's leading blockchain adopter among institutions, and they support digital wallets, custody, trading, investments, ETFs, and tokenization, which is every single metric we track in this report. And in January, their CEO had this to say at the World Economic Forum in Davos. If you're frightened about debasement or local political instability, you have an international instrument called Bitcoin to overcome those fears. And that's essentially a green check mark on using Bitcoin as a hedge against volatility, local currency inflation, debasement, government instability, all the above, all of which appeals directly to emerging markets. And he went on to say, I was with the sovereign wealth fund during this week, and there was conversation about should we have a 2% allocation, a 5% allocation. And if everyone adopted that conversation, the road to a $500,000, $600,000, even $700,000 Bitcoin price is pretty clear to see. So looking now at the sixth largest financial institution in the world, Fidelity. Fidelity is also a world leader in blockchain crypto adoption. And not many people realize it, but really credit to CEO Abigail Johnson's forward thinking. Really impressive. They've been deeply involved in crypto and digital asset technology since as early as 2014, when they started mining Bitcoin in-house fairly quietly. I wouldn't say under a shroud of secrecy, but it wasn't publicly disclosed or publicly known, I should say. By 2016, they'd already partnered with Coinbase, but it wasn't until 2018 when they officially launched their digital asset trading and custody arm that people really understood how involved they were. Then they published their official Bitcoin thesis in 2020, which is almost 5 years ago now. And subsequently, they launched index funds, retail products, were the first to enable Bitcoin purchases in 401ks, and now have Bitcoin and Ethereum ETFs as well. And I'll just say that their retail tools, which I've also used myself, are also very robust, and I've been impressed with the continual improvements they've made. I now hold personally Bitcoin and Ethereum in my Fidelity app, and I have Bitcoin in my 401k and Roth IRA all through Fidelity. And finally, looking at number 9 on our list, JP Morgan Chase, which manages over $3 trillion and employs nearly 300,000 people around the world. We see a classic story, which is familiar to people who've been in this industry a long time, where public institutional leadership is remaining ambiguous and risk-averse in public statements, but in the background, their institution is one of the biggest adopters. And this is why we always say, watch what they do, not what they say. CEO Jamie Dimon has been one of the infamous holdouts, naysayers, and often quite flippant about crypto. However, last year he subtly shifted his stance, and I don't know if everyone picked this up last year, but instead of saying he's anti-crypto before, he's now saying, well, I don't agree, I'll defend your right to buy Bitcoin. How noble. But meanwhile, in the background, his own firm has been one of the most active adopters of the technology. JP Morgan launched their own blockchain platform 8 years ago now. In 2020, they'd issued their own payment stablecoins and launched a tokenization platform. By 2022, they were offering Bitcoin to their wealthy clients and had a registered trademark for their own crypto wallet. By 2023, they'd already processed $300 billion on their own blockchain products. And come to today, they are quite active and they support all of the digital finance activities we track in this report. So just to recap the overall results of our Q1 2025 institutional adoption report, the headline is that institutional adoption continues to rise. The world's largest financial players are already adopting, using, and supporting digital assets, starting with wallets, custody, and trading, supported by more than half the top 50 managers, and followed by support for digital monies and payments, supported by more than half as well. And finally, tokenization is also on trending, up 4% since our last report and more than 20% since the one prior to that. And we have to keep reminding ourselves, we've seen this before with the internet. After its first big boom and bust, many people said it was over and that the whole internet was just a fad. They gave up. They pulled out their money and they missed out on the greatest value creation event in history. On the flip side, investors who stuck to their convictions in the technology saw some of the greatest returns ever. And today we believe we are at just the same point in digital assets and blockchain. And for savvy investors, we think the implication is quite clear. Position yourselves to benefit ahead of the massive transition that's about to take place to natively digital global commerce. And that will be enabled by blockchain technology. And I'll add here that the rise of artificial intelligence only makes this point more critical because it both spurs the need for a blockchain-based identity solution so we can tell what's a human and what's a bot going forward, but also because as AI agents start to interact in the world autonomously and do things on your behalf, they're going to need natively digital currencies to interact without losing scale and speed. In fact, using the antiquated legacy financial infrastructure and automated clearinghouses and not will actually be a huge obstacle and will slow down AI greatly. So in conclusion, our investment thesis is proving more true than ever before. Blockchain is now at an inflection point, and digital finance is clearly inevitable. Institutions are rising up to embrace this asset class, and so are governments. Yet, if you invest now, you are still early. In fact, more than 5 billion people in the world still don't own any exposure to this space. But you won't be for long. If the report results tell us anything, the world's institutions are pouring into the space, and they're going to bring a lot of capital, and retail investors will follow. So if you are interested in learning more or chatting with our investment team, please shoot us an email at ir@blockchaincoinvestors.com or visit us at blockchaincoinvestors.com. We really believe this is the opportune time to deploy capital ahead of the transition to digital finance. And on that note, I will close down this webinar. Thank you all for joining this Q1 edition of our biannual Institutional Digital Finance Adoption Report. And I hope to see you all again shortly in April for the release of our next digital asset regulatory report. Thank you.